Interestingly, one price indicator is beginning to hold up better than other prices, and that's Bitcoin.
Hey guys, welcome back to Library of Wealth. Today we have ARK Invest CEO Cathie Wood discussing her outlook for the current bear market, as well as the impact that the stock and cryptocurrency markets are having on Bitcoin. Cathie will also talk about her financial outlook for the coming several months and whether or not she can see an end anytime soon. Although the effects of the recent economic crisis are currently being felt by Bitcoin, Cathie highlights other nations that are also going through a currency crisis and haven't yet seen the worst of it. She thinks that the current economic downturn is just a preview of what is to come. We will examine her forecast for Bitcoin, as well as her investment strategy for the stock, cryptocurrency, and capital markets. Let's listen to Cathie's prediction about the current market collapse, the recession, inflation, and the effect of interest rate hikes on capital sectors towards the end of our video. Don't forget to like and subscribe if you like the content we do here on this channel. Let's get right into the video.
Markets are selling off across the board, and that's very unusual. It's associated with crises and more convincing evidence to us that the Fed is too tight and that it will pivot. And when it does, it will do so, we think, significantly. Now, first, it might simply be rhetoric, because they always like to tee us up for what the next moves are going to be. And we haven't heard that rhetoric yet, despite all the evidence I just shared with you. But that evidence I just shared with you tells us that the Fed is going to get the message loudly and clearly somehow. And it may not be showing through in the numbers they want to see, but it will. It will. They are huge lagging indicators. They're basing policy on lagging indicators. If you take, in the US alone, if you take equities and bonds and look at what's happened since the peak, you will see that the loss to investors is more than twice what we saw in 08, 09. That's how bad this is, because bonds are selling off with stocks this time. And one of the reasons for that is a seizing up of liquidity. As I mentioned, if people are facing margin calls or in financial difficulty, they're going to sell their most liquid asset. They will have no choice, especially with margin calls. Most liquid assets tend to be government bonds, and I think that's why we're seeing the backup in government bonds here, despite all of the deflationary signals in the pipeline. Interestingly, one price indicator is beginning to hold up better than other prices, and that's Bitcoin. It's been interesting to see it flatline in the last month, while other indicators are reaching for new lows. This is not surprising in the late stages of a bear market. In our experience, innovation starts to outperform in the late stages of a bear market. Why does that happen? It happens because innovation is the new leadership. Innovation solves problems. Innovation solves the kinds of problems we have today: supply chain, food, energy shortages, think the genomic revolution, electric vehicles, and so forth. And so we believe that innovation should outperform if we're toward the end of this bear market. If the Fed's close to pivoting, even in its rhetoric, I think we are.
Cathie believes the Federal Reserve is making a huge mistake with their monetary policy and thinks that more pain is coming for the housing, credit, and crypto markets in the coming months. Wood believes the drastic actions by the Federal Reserve are crashing the market, but says that these actions are resulting in suppressed pricing, which provide the savvy investor with substantial investing possibilities.
Steve Vanelli, who is the CEO of Knowledge Leaders Capital. And Steve has done factor analysis, uses factor analysis. He's somewhat quantitative in his orientation, and has defined innovation as a factor. And according to his quintile spread for the R&D to sales ratio factor, He believes that the major underperformance is done. And if you look at the PE to growth ratio of the innovation index that he has derived, it is now selling at a 31% discount to the PE to growth, or the PEG ratio, of the S&P 500. This innovation kind of strategy bottomed in May, whereas the broader-based indices, which we would submit are being disrupted, they hit new lows just in the last 10 days. It feels like we're moving towards a cathartic moment. And, I think that the 75 basis point increase, if that's what the Fed is going to do, is going to result in some financial signals that the Fed will have to pay attention to. Maybe it didn't have to pay attention to the Gilt trip, but it should, because it is the reason it should have the Gilt trip, because it is the reason that near Lehman event happened in the UK. And so it is darkest before the dawn. We think the pivot is close, if in nothing else but rhetoric in the short term. And we certainly hope that the Fed gets away from this need for unanimity and a united front, when really we have all of these Fed members and presidents for a reason to debate. And we feel that debate is being stifled. The debate should be driven by data, but it cannot be. If it were, they would not be unanimous in their thinking right now. So let's hope there are some dissenters, and let's hope there's some rhetoric change. There are all kinds of reasons out there, data-driven reasons. And so we hope the Fed is paying more attention to all of the data instead of just a selected few pieces of lagging indicators.
Wood believes the Fed rates will decrease, but says it's currently showing signs of extreme weakness. Along with the household employment charts being down for the last 4 months, Wood has never seen a swifter increase of the bottom. Many people haven't realized we've gone up about 50% from the previous lows. Wood believes that we are currently moving into a serious recession. The only difference is we don't have access to the systematic excesses like in the pre-08-09 mortgage market. Wood says that the ongoing decline is partly due to China beginning to unwind from this cyclical point of view. She says that the Fed doesn't care what happens to the economy now, and they're overly focused on inflation. If Wood's interpretation of deflation as cyclical is correct, the coming deflation will actually be a good environment for the financial market's growth. What do you guys think about Cathie Wood's market outlook for this year, and how the Fed is handling inflation indicators? Let us know in the comments below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.